really happy that we're going to be having this opportunity for you to hear from Bruce again. I think that Bruce's company is a perfect example for all of you at this stage in your new ventures experience because he sat where you sat just a few years ago. And I think what you're going to get tonight is a very valuable look at the whole process from founding all the way through to my personal favorite part, which is the exit. So an outline of what we're going to be talking about is really using the case study of Singular Software, Bruce's company, to illustrate the things that we think you should be thinking about at this stage in your company's evolution. And to help you understand a bit about where Bruce and I have come from, we want to tell you just a little bit about ourselves to put some of our comments in perspective. So like some of you, I'm a geek, nerd, techie, whatever you want to call somebody who's been fascinated by technology from a young age. Like Bruce, I got a PhD. Mine was in electrical engineering. I was at the UBC and graduated in '82. I started my first company when I was actually in grad school. They didn't have New Ventures BC back then. And we grew that pretty nicely for about a decade and sold that to a company, and it's now part of Cisco, which was my first exit experience, and really got me to appreciate that of all the things that I did through that startup experience, my favorite at least was that exit. And what I did with the money I got from that was to try and find a way to invest it and make a return. And through that process, I've managed a hedge fund, a venture capital fund, and an angel fund. Again, all helping me appreciate that the really hard part of everything that we do as entrepreneurs and as investors is the exit. And now what I do and what I have the most fun doing is helping companies like Bruce's, when it's time, go through that last stage in their evolutionary process and help them be acquired well. And that, for me, is about as much fun as I'm allowed to have these days. I've made about 100 early-stage technology investments in my career, and about half of those have produced a return. And I've been involved directly in helping about 100 financings get done during all the years that I've been doing that. And I've worked on several dozen exits where I actually had hands-on, having sold almost all BC technology companies.
Perfect. Hey, everybody. I have a PhD in math and physics, going way back to 1984 from UBC. And that's how I ended up in Vancouver, was coming out here to do my graduate work. I grew up in Ontario originally. Like most people, once you get to the West Coast, you typically don't leave again. My first real job after getting my degree was at McDonald Detweiler. Although before that, there was a job at a startup which lasted for about a year and a half. I wasn't a founder or anything. I was just an employee, and I learned a little bit about how not to do a startup from that experience, but it's much more interesting to learn from successful startups than unsuccessful ones. But it was really at McDonald Detweiler that was my formative experience, I would say, and that's a very well-run company, and I learned a lot about business and all sorts of things. And I was on the technical side of things there, and was literally a rocket scientist for a few years there. Worked in areas, a lot of digital signal processing, satellite image analysis, that kind of thing, which we'll hear later kind of came back as a technology background, which played into the company that I ended up founding. So after leaving McDonald Detweiler, I went to a series of companies, Advanced Gravis, SoftQuad, Blast Radius. Essentially got into a pretty different realm, having to do with XML in the enterprise, content management, that kind of thing. All the way along, though, I'd had this hobby of making films and shooting video. And that hobby, as we'll hear a little later, turned into my startup. Well, it kind of started with my kids. When you have kids and they're putting on their dance recital, whatever it is, mommy and daddy go with the camera, and you want to keep that for posterity. We never look at those videos anymore, but it was fun to shoot them anyway.
Now, I believe that this is a history, when we look back at this time that we're in now, is going to call this period a golden era for entrepreneurs and angel investors. And I think that it's clear that never before has it been so easy for entrepreneurs to create such valuable companies on so little capital and to sell them so early for so much money. But on the other hand, I also believe that only 25% of the companies that could be successfully sold end up actually succeeding at their exit. So what I'm saying is that if you have the courage and tenacity and luck to build a valuable company, I think that only a quarter of those are actually going to be successfully sold. And we don't have data to prove this yet. This is kind of my observation after looking at the local and sort of global ecosystem for several decades now, that I think the odds at that last stage are still very much against the entrepreneurs and the angels. And I think that if you look at it, it looks sort of like this. I think about a quarter of the companies that could be sold have a successful exit. Another quarter have what I call poor quality exits. And that's where usually you just get a really bad price. It's usually where the company gets sold for a lot less than it could have because the timing wasn't right, or the team wasn't capable, or just because the buyers were that much better at negotiating a price. And then about a half the time, there's no exit at all. And that's what I want to try and talk about tonight, is how to help you avoid being in that red half of the distribution. And keep in mind that these are of the companies that made it all the way through. And here I'm talking about primarily angel-backed and bootstrap companies. This would look a little bit different if you had venture capital-backed companies. They have a little bit higher chance of exit, primarily because so much more capital has gone in. So what I want to help you think about is how to be part of the 25%. And I think that the biggest shortcoming is actually a lack of knowledge. And this is why I'm so happy to devote some of my time to coming and talking to audiences like you, is just to help get some more of the ideas out, things that I didn't even know when I was a young entrepreneur and running a company, and especially things that work well in the economy today. Lots of things have changed in the last just decade in this regard.
So back to my hobby of shooting video. As I mentioned, it was kind of my kids that got me, kind of renewed my interest in doing that. And quickly, together with my wife, realized that you get much better videos as an end product when you have more than one camera shooting what's going on. If you're focused on whoever's singing at the moment, you might miss your own little Susie over here who's doing something interesting if you've just got one camera. You want to have wide shots, you want to have close-ups, you want to mix them together, and if you take the time to do a little editing afterwards, it makes a huge difference. So we pretty quickly got to the stage where we wanted to shoot with at least a couple of cameras. I'd have one, my wife would have one. If there was other people in the audience that had cameras, other parents, whatever, we would take their video as well and put it into the mix. Having good quality audio was always of great interest to us. I'm a little bit more of an audio guy in some ways than a video guy, and it was crucial to me to have good audio. And because these are live performances, we didn't have much chance to set up. There wasn't a house system with a good AV setup or anything like that. We had to just kind of show up and plug in quickly. So I really fell in love with these small, portable, battery-operated audio recorders that give terrific sound and really easy to use. The problem with doing all this is that the dance recital's over. Now it's time to edit all this together. All these cameras and the audio recording and everything, they all started and stopped at different times. Before you can put it together and start getting your different angles and so on, you got to synchronize all that stuff together so that the same things happen at the same time in this timeline that you end up working on. So there's a synchronization problem. Now, this has been around forever. In Hollywood, they use slates, when they go, take two, scene one, take two, clap. The reason they do that is because that gives them a sound, the sound of that clapper going down, and that gives them a visual cue that lets them synchronize the sound and the video together. In the case of like network TV or high-end TV setups, they'll have several cameras running at the same time. Essentially, they've got wires running to all those cameras that are sending timing signals out to them. And they use those timing signals after the fact to do that synchronization. But we live in a world where there's a lot of absolutely terrific video equipment, audio equipment, which doesn't give you those options. That time code option of sending that signal on the wire. They just don't even build that into these things anymore, except the more higher end ones. Time code's expensive, it's fiddly, it takes a certain amount of expertise, it's fragile. It's not that great. And so for us, working at the lower end of video production, just wasn't even an option. So what is the option? Well, you end up syncing by hand. Either use a clapper, or you use something that you kind of look through the footage and look for something that happened that you can see in both cameras and use that to line things up. It's awful. It's really no fun at all. And so I thought, there's got to be a better way to do this. After we were doing this for a little while, we became the go-to parents for these videos. All the other parents would just buy a DVD from us at the end of the day because we cared so much about getting good quality out of the whole thing. So we're making a little bit of money, and I thought, well, let's relieve the pain here by spending a little bit of money on some software that'll help us with a synchronization problem. Scoured the internet. There wasn't anything. I couldn't believe it. So I thought, and this is where my background at MDA and some of the digital signal processing, image analysis came into play. I thought, you know what? There's a solution to this problem. This has got to be doable. How hard can it be? Well, the how hard can it be part took a few years, actually. I did a lot of the initial coding work myself, which was a lot of fun. By this point in my day job, I'd moved into various executive positions. I wasn't really hands-on technically at that point. And so it was a lot of fun to get back and get hands-on with the technology stuff again. So one thing led to another, with the help of a few contractors, but a lot of the work myself. We were able to launch a first version of the product, which works with Apple's Final Cut Pro video editing software. And we took that to the big trade show of the industry, which is the National Association of Broadcasters show, NAB, in Las Vegas in 2009. And shortly after that, we brought out support for other of the popular video editing packages from Adobe and Sony and others. I was still pretty much doing everything at this point, not only the technology side, but the business side of the business as well. And my first milestone that I was really looking forward to is when we were getting enough income that I could hire my first employee, so I didn't have to do everything. So the timeline of this company looks like this. So we're sort of going a little bit back in history again now. So in 2007, I incorporated the company. I knew I wanted to do this thing. I'd been fiddling around with it already for a couple of years up to this point. Realized I had something, realized there was commercial potential. I wasn't just solving my own problem, that other people would want this solution as well. 2008, I put this company through the New Ventures BC program. That was terrific. It came at just the right time for me because it was a time when I knew I really needed to finish my business plan, and going through the process of New Ventures kind of frog marched me through the process of completing the business plan. Plus, you get all this terrific feedback from mentors, and you get their terrific seminars and things along with it. That was great. 2009, we shipped our first product, and sometime in the next year, we hit a run rate revenue of $1 million, and was able to hire 6 people in the organization, not just one, but 6. The following year, we were well on our way to $2 million revenue, run rate revenue. We got a patent granted that broadly covers the technology that we had developed. That was terrific. We were the first to market with anything like this. It was quite novel, and we're still very much the leaders in this. The product name is Pluralize. Those of you in the video business may know of it. Still very much a leader in that realm. There was one really lucky event that happened along the way here that made our business grow a lot faster than it would have otherwise. I think we would have been successful anyway, but this really helped a lot. And that was just around the same time, in that early 2009 era, around the time we brought out our product, Canon, bless their hearts, brought out a new camera, the Canon 5D Mark II, which was a still camera, a DSLR, digital SLR camera. And at the request of some of their larger enterprise customers, they'd added a video mode to it. And this is the first time anybody had done this, really, in this kind of a form factor. And the quality of the video out of this thing was astounding. It was so good that it just, overnight, turned the whole industry upside down, much to the surprise of Canon and everybody else. The video quality out of this camera was fabulous. The audio quality, not good. And all sorts of reasons for that, but that's just the way it is. So that everybody knew that to have audio of the quality that would match the quality of their video, they needed to have a separate audio recorder, which means they all had a synchronization problem, which meant that our product was the thing that they also needed to buy when they bought their Canon camera, and then they bought their audio recorder, then were the third leg of that stool. That helped a lot. Says luck on the slide here. Luck is a theme that of my life and my business career that it comes back again and again. I think to have a successful business, I think you do need large elements of luck. Seems like you can't do anything about that, right? You're either lucky or you're not. But what you can do is to give yourself the chance to be lucky. And that's basically my philosophy of life, is give yourself the chance to be lucky. In this case, we got lucky by being able to be at NAB, that first show where we launched the product, because I happened to be signed up to a mailing list and just to try to stay plugged into what's going on in the industry. And then someone mentioned that there was this slot available. There's a group of plugin developers, basically, that sort of share space at NAB, and there was an empty slot they were looking to fill up. Does anybody want to take that slot? I said, sure, I'll do it. Great, I just need a little space for the booth. So that was the first lucky thing, to have that availability of that. Then an unlucky thing happened, which turns out that wasn't available after all. They'd made a mistake in calculating the space that was available. But then somebody else said, you know what, our booth's a little bigger than we need. We'll shave off a little 5-foot slice of a booth area for you. Do you want it? I said, yeah, why not? Go, something might happen, right? And it was terrific. Even in that little slot, we got a chance to interact with lots of initial customers. We hadn't actually launched the product then. We were just weeks away from launching, but it gave us a great time to talk to customers as they came by, start forging business partnerships, all these sorts of things. So glad that we took advantage of that opportunity. On to you.
Thanks, Bruce. What I'd like you to think about as we start to think about the life cycle of your company is that there's really two types of companies, or you can divide all companies into two types. One is companies that are built for cash flow to the owners, and the other type are companies that are designed for an exit. And I didn't really appreciate this when I was a young entrepreneur. I just thought you built a company because that's what you were destined to do or driven to do. But I don't think, and Bruce and I have talked about this over the years, I don't think either of us really had this clear in our own minds when we started out. And the key point here that I learned after being an investor for a couple of decades is that only one of those two types of companies works for the investors. If you have the first type of company, you should not even speak to investors, and heaven help you if they accidentally give you some of their money, because then you've got a really big problem. So if you're talking to investors, if you think you need capital to build your business, you're certainly in category 2. But even if you're like Bruce's company and you don't need any capital, the chances are you're still in number 2. And because you've heard a lot of other people, some of whom are my very good friends, talk to you about investors, I want to add a little bit of a counter opinion about whether or not you might want to have investors in your company. And having been one for a couple of decades, I think I can say quite honestly that investors are a pain. And if you think about wanting to have investors, you should be prepared for the fact that they're going to want a ton of documentation, they're going to expect financial reports, they're going to want to attend board meetings, and they're always going to want to help, which sometimes is a really good thing, but sometimes it's sort of like the government wanting to help. And they're all absolutely for sure going to want their money back. And I think that one of the things that all entrepreneurs should appreciate is that before you speak to the investors, you've got to be able to answer the question that's most important in their mind, which is, how do I get my money back? And this is what I want to talk about for my part of the rest of this talk, is how you think about find the answer to, and then communicate that key point in your startup strategy. And what I'm going to suggest, I want to admit, does not happen most of the time. I wish it did. I think we'd have more successful companies and more millionaire entrepreneurs if we did. But I think that the right way to build a company is to, first of all, determine the type of business that you have, build alignment on your exit strategy, then develop the financing plan, and once that was clear, start to talk to investors. And the reason I think that's so important, I think of, is best illustrated by this biological model. And the way I look at it is that when you're starting a company, you're probably combining the DNA from a number of founders. And usually founders are very compatible. They're often the same kind of age, they have the same kind of vision, they think the same, they often eat the same foods and do the same things on the weekend. So the entrepreneurial DNA in a startup is usually quite compatible and gets along quite well. But what happens when you start to talk to investors is that if you're successful, you're going to end up combining that investor DNA along with that entrepreneurial DNA. And the reason I like this model so much is that what you end up with is, post-investment, a new hybrid organism that is a hybrid of the two types of DNAs that you've combined. And the reason I like this model is that we all know from biological systems, if you combine incompatible DNA, sometimes things seem to go along fairly well for a little while. The organism might grow, it might even be seen to be prospering. But then usually, around preschool or whatever, you realize something's gone horribly wrong. And at that point, you can't fix it. Like, we don't know how to undo that, which is exactly what happens in my mind when you combine the investor's capital and your company. You can't undo it later. There's no way to say, oh, sorry, Mr. Investor, we're giving you the money back. I haven't ever seen that happen. So what I wish people did in startups was to check the compatibility before you made the decision to combine that specific investor DNA with your entrepreneurial DNA, just so you don't wake up 5 years down the road and realize that something's gone horribly wrong, and at that point, it's too late to fix. And the reason this is so important is that different types of investors are compatible with different types of exit strategies. And if you make a mistake about this, it can easily cost you your entire company. And it almost cost me my first company. And I've got a video on my blog that's always the most popular of the videos that I've got up there, where I finally had the courage a few years ago to describe everything that I did wrong in my own first company and my own first exit. And I describe how very close I came to losing 11 years of my life and millions of dollars of equity that I built up because I didn't know how important this first rule was when you're designing and building your company. What I'd like you to think about tonight and hopefully in the future is that I would suggest the exit is just another business process. And we all know from running businesses or working in companies that whether you're doing a financing, a product development, a marketing, or whether it's a sales plan, the chances of you having success increase dramatically if you have a good plan. And I would suggest that the exit strategy is simply the plan for your business, the entire business. And like all good plans, it should start at the end with the goal. The exit strategy doesn't have to be a complicated thing. In fact, there's really only two essential elements. All you really have to figure out is when are you going to sell and how much are you going to sell for. That's a perfectly sufficient exit strategy. You can make it more complicated. You can make it fancier. You can add in things about how are you going to execute. But really, it's only two essential ingredients, when and how much. There are a few other options. And you could be thinking about driving to an IPO. That's another type of an exit. But the important thing is to check the alignment of that exit strategy amongst all of your principal stakeholders. And I think you should do that at least annually. As we all learn about this, in the last few years, a lot of my friends in America are now believing that you should check the exit strategy at every board meeting. And some of the most successful investors in the world now are making that a regular part of every board meeting, to start the meeting and say, okay, just to start off, to remind everybody, this is our current exit strategy, this many months, this many dollars. Anybody have anything they think we need to discuss to change that? Okay, we're sticking with this, all in favor. And that one little thing that you could do to your company might increase your chances by 20 or 30%, I don't know, but I think it would have a significant impact on the probability that your company hits that goal just because of that additional alignment and that focus on what it is you're all trying to do really when you get up in the morning and come to work. It's sometimes difficult to get that alignment. If your company's been around for a while, luckily most of you are at the early stages, but I've often found that it takes more than one off-site planning retreat just to get an agreement on what that exit strategy should be. It's not easy. People will have wildly different opinions, and if you don't get a chance to talk about it, you may never know until you're actually faced with the prospect that your partners, maybe even the founders, don't have the same vision as to where the company is going. When I was a young entrepreneur, it didn't seem to matter whether you were building a hardware company or a software company. Most companies cost tens of millions of dollars to build. All the companies that happened when I was working as an entrepreneur the ones that succeeded had venture capital money, and they had lots of millions of dollars in there. And that's what created the entire venture capital industry. You might have even had some talks here about venture capital as a source of funding from some of the people that I used to work with. But there's a lot of common misperceptions about how this all works today. And that industry has changed faster than almost any industry in history has changed. Because bootstrapping today, I think, has become the best option for the vast majority of companies. And that may be different from what some of my friends may have set up on this stage a few weeks before. And yes, I make a good part of my living from being an investor. And I will also admit that some business models just cannot be bootstrapped. If you want to find a cure for cancer, you're going to need some big money. You're going to need venture capital to do that, most likely. But if you really can't bootstrap your company, what are your options to raise private capital? And sometimes what I do for fun is I ask in this room how many of you are planning to do a VC fundraise for your company. Let's do it again. Anybody here think they're going to raise venture capital? Still? That's interesting. No, anytime in the lifetime. So anytime in the lifetime of your company, who expects to raise venture capital? More even. Man, that's amazing. How many are planning on raising money from angel investors? Okay. And how many are planning to bootstrap? Angie, there's an educational gap here. The reality is that probably nobody in this room will raise venture capital. There's probably one company every several years in British Columbia that needs venture capital. I've had this debate with lots of people, and I've asked, and one of these days I might put up a website and say, okay, which companies needed venture capital? But it's in less than a handful every decade. So the chances of you creating one of those companies is just statistically a pretty low probability. There certainly aren't two of you in the room. That's just math, by the way. That's statistics. And I used to run a venture capital fund, so I came by these opinions very honestly. Angel investors are 27 times more likely to invest in a company at your stage. So, if there was 27 hands that went up that said angel, then there'd be probably one hand that should go up to say venture capital. Those are actually the statistics. But what's interesting, and what you're going to hear more from Bruce on, is that bootstrapping today is a real option. And I'm sure all of you have read The Lean Startup, and there's just such a lot of change that's happened in the entrepreneurial ecosystem in the last decade. It's amazing. And it's part of the reason why I think this is a golden era. It's never been so easy to build a valuable company on so little money. But if you actually look at it, it is 27 times more likely it's going to be angel rather than VC. And for fun there, I started to keep some statistics and some good articles on that if anybody's interested, or if you want to finally beat that perception of needing venture capital out of you, there's a whole bunch of 100 articles there that are referenced that are from smart people that'll help explain why that's probably not necessary. Angels, it turns out, invest as many dollars as VCs also. So they invest in a lot more companies. But the real money, it turns out, is your friends and family. If you think you need capital, as horrible as it sounds, the best place you could go is probably to your friends and family. They invest 5 to 10 times more than VCs or angels. And we only discovered that 5 years ago, or 15 years ago, pardon me, 5 years ago.
It's great to hear Basil talking about bootstrapping. That was the key question one of the key questions for me when I went through the New Ventures process. Do we seek outside investment of any kind, or do we just try to bootstrap? And I was really looking at it both ways. It seemed like if we brought more money into the company, we could perhaps grow a lot faster, maybe go after a bigger target market. But I was never able to convince myself that that bigger thing was there, really. But it was also one of the presenters at New Ventures who was really talking about how do you pitch to investors and so on. That was this whole thing. And at the end, I said, well, I can see you're giving a very investment-oriented thing here, but I got to make this decision. Like, I think maybe we can bootstrap, but we have this other option of getting outside investment. What do you think I should do? He was completely clear about it. Just what Basil says. If you can bootstrap, do it. Your life will be easier. Everything will happen faster. You'll be happier. It'll just be a much better ride all the way along. And that was the day. I said, okay, that sounds good to me. We're bootstrapping. Fortunately, for a company like ours, and in this day and age, it doesn't take tens of millions of dollars, like Basil referred to for starting companies a long time ago. It's more like tens of thousands of dollars to at least get started. And friends and family, in this case, turned out to be just me dipping into my own savings. It doesn't take that much. Now, partly that's because I put a lot of sweat equity into it myself, and as I mentioned, I was kind of doing everything, both on the business side and the technology side. My particular career path had given me some experience on both sides, so that was pretty helpful. Although I did look at bringing partners in with me and so on, although I would have insisted that they just not take a salary right off the bat, sort of thing. But in any case, we were able to get going for really not very much money. And the other thing that's great about it, software business in particular, but other kinds of businesses as well. In our case, we're making software. We put it on our website. People come to the website. They try it for 30 days. If they like it, they buy it. They put in a credit card, and the money just comes to us. To make that all work, you need all sorts of things. You need a website. You need a store on the website. You need credit card processing. Blah, 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 blah. There are so many options to do all of those things really, really cheaply and to pay as you go. You don't need to set up a lot of infrastructure. And our philosophy was always to outsource as much as humanly possible. In terms of hiring people or anything where we would invest in capital internally in the company, it was just for things that are really around our core competence. Running a website, processing credit cards, that is not part of our core competence. So we just paid someone else to do that. It's a little more expensive when you start to scale up, but once you get up to scale, then you can look at other options for reducing those costs. But it's not prohibitively expensive at all. It's cheap, cheap, cheap. So in our case, again, partly because of the luck of our market all of a sudden expanding overnight, bigger than we thought it was going to be, and because the product is easy to sell, it kind of sells itself off the website, we quickly became profitable and stayed profitable almost from day one. One other aspect of my company, I think, is also becoming more and more common, which is that we were an entirely virtual company. So I talked about hiring 6 people, and there were various contractors that would kind of come and go. We never had an office. All those people that I hired were in the Lower Mainland area, and we could have commuted to an office, but I didn't want to do that. I wanted to work at home and not commute. And I hired people who were of the same frame of mind, which surprisingly to me was not everybody. There was one guy in particular, I really wanted to hire him. It would have been great, but he says, I can't do it. I can't work at home. I got to go to an office. I got to have other people physically around me. And okay, then didn't do it with him. But that's worked out really, really well. And you take advantage of things like Skype and Google Hangouts and so on. And to this day, I have stuck with doing that. You have a daily call with your whole team. When it's a team of half a dozen people, you can do this. You have your daily call with the whole team. Everybody knows what's going on. And you don't have to physically be together. And in fact, you end up communicating much better that way than if you're in a physical office together, in my experience. There's a tendency to think that if you're in an office and you're kind of bumping into people at the water cooler that you're actually communicating. Not necessarily. They just happen to be physically near you. If you're on a Skype call every day and you're talking through issues and things, yeah, you're actually communicating. Everybody knows what everyone else is doing. My philosophy, the last point about spending money to make money, I was never shy about spending money to make money. To get the initial round of the software done, we needed some Mac software. I was really rusty in my Mac programming skills, so I outsourced that to a company in town that does that. I gave them a very specific thing I wanted them to do to basically just get me over the hump of getting a piece of Mac software written as a core of the product, and then I could take it from there and build on that. That worked out really well. Hiring a PR firm, spending a little bit of money on marketing and this and that, it's all, you want to spend the money judiciously, especially when it's coming out of your own personal savings. You are keenly aware, but don't be penny wise and pound foolish, as the saying goes. It takes money to make money sometimes. Fortunately, not a whole lot of money to make money, but a little bit.
One of the things that I think we have to be careful about is that it's human nature to get excited when you read about really big transactions. Here in British Columbia, it was pretty exciting to read about Club Penguin getting sold for $350 million to Disney, or when Customs House in Victoria sold for $370 million to Western Union. Layer 7 sold last year, and while it wasn't announced, I hear that it was $160 million or so. I think that the actual big news story is the much larger number of small exits. And when I went out to try and understand what the average size of a sale was when a company was sold, it was actually pretty hard to figure out. There's not a lot of data out there. But after spending an embarrassing number of Saturdays and Sundays digging through databases, it was pretty easy to show that the median price when a private company is sold is under $20 million, and I'm pretty sure it's under $15 million. And this was a real shock to me because I had thought from the stuff that I read that, when you sell a company, it's like $100 million or $200 million. And the reality is those are kind of black swan type of events. They happen here in BC, for example. I think we sell a company for more than $100 million every other year on average. And when you think about how many companies are started, you start to appreciate what the probabilities are that any one company might sell for a price in that range. And it's important, I believe, that when you're building a company, and especially when you're thinking about capital, to remember that the probabilities are about 50% that you're going to sell for less than $15 million. It might even be less than $12 million on average. So you've got to calibrate your plans and your thinking around what's probable to happen. And that's a number I think we should all keep in mind. And when you're thinking about the ways you could sell your company, the ways that you could exit, there's really only two options. You can do an IPO, or you can have an M&A transaction. In other words, you can sell the company privately. These days, if you actually looked at the numbers, it's almost entirely M&A transactions. There are a very few IPOs starting to happen again in tech. Results are kind of still spotty, but the probabilities are, again, about 90-some-odd% that you're going to exit through an M&A transaction, not through an IPO. And the reason this is happening, and one of the reasons that things have changed so much in the last 10 years, is really well summarized by a friend of mine who runs a big part of a Fortune 500 company. And we were out for lunch one day, and we were talking about this, and he said, from his perspective, running like $1 billion part of a big company, he said, it's pretty easy. He said, we, the big companies, basically know now that we aren't good at new ideas or startups. They admit it out loud now. And he said that they basically suck at building businesses from $0 to $20 million in value. But what he did say was that they thought of themselves as being particularly good at growing values from 20 million to, say, 200 million. They saw that as their core competency. And since he said that to me, there's been some fascinating new research come out of the Harvard Business School that actually says this much more eloquently. And it says today that one of the things that's changed is big companies don't even try to innovate anymore. But what they're doing instead is, and as my friend went on to say, he said, if I could buy a company for $20 million every month, I would do that. And he said that in his company, they're spending much more on acquisitions than they are on R&D, simply because they've learned that that's the best way for them to grow. in essence, they've outsourced the innovation to people like you. The job of the entrepreneurs in our economy now is to come up with the good ideas, grow them, and then most likely somewhere in that kind of $15, $20 million range, again, talking probabilities, will be acquired by a big company. The big company is going to have the cash, it's going to have the resources, and it's going to have the experience to grow that up to a couple $100 million if that business was a good business. It's also, even today, something that's obvious to the public shareholders. Public shareholders, when the company does an acquisition, they cheer, the stock price goes up. If one of those companies was to announce a big R&D project, the stock would tank. The investors don't want them to do that, so they're doing what their bosses, the shareholders, say, go out and buy companies. My friend's point was he couldn't find enough to buy. That's why he wanted to have lunch with me. I thought I might have had a company that he wanted to buy. Google did us all a big favor a couple of years ago when one of their guys, Charles Rim, who's one of their top 5 in the world kind of acquisition guys, did a webinar. It was a fascinating webinar because you can hear in his own voice what he said. He said, 90+% of our transactions are small transactions, less than 20 people, less than 20 million, and that is truly the sweet spot. And that's Google. They have more money than like almost anybody, more money than some countries. They wanted to buy companies in that same range, around $20 million. That's where the market is today. That's what the exit market looks like. He went on to say something that surprised me. He said, we do prefer companies that are pre-revenue. And I haven't had a chance to actually track him down and ask him exactly what he meant by that. I'm pretty sure, though, that what he means is before any appreciable revenue. So what they're saying is, if you've got a good idea and you've built a business, don't try and scale it up. They're not going to pay you anything more for that. Don't raise a bunch of capital and try and make it 5 times bigger. They're not buying it for the revenue. Whatever revenue you have does not matter to Google. They're interested in your ideas. They're interested in your intellectual property. They're interested in your team. They don't really care about the revenue, in their own words. If you actually wanted to listen to that, it's up on one of my blogs. I managed to get a capture of that webinar. It's fascinating to hear him say that in his own words, because you don't often hear that kind of candor from the people that are out there doing the buying. So today, in our economy, what seems to be working is that the small companies are doing the innovation, and they're often bootstrapped. Sometimes friends and family or angels will finance them, and then big companies come along and buy them early, and then the buyers grow the business. What the entrepreneurs and the investors do is they then recycle those capital gains, and they start to do it all again. If you want to see that happening here in BC, go up to Kelowna. See what the guys who sold Club Penguin have done. They've invested in more companies than probably all the venture capital funds in Vancouver have during the same period of time. Just 3 guys, just putting the money back to work because they're techie nerd entrepreneurs just like Bruce and I, but they have so much money that they're trying to put some of it back to work in the economy. The other thing that's happened just recently is the internet has changed everything. We've seen this in every aspect of our lives. But you now take for granted that you can market to people all over the world in just a couple of days. But it's also accelerated almost every other aspect of the startup life cycle. And you probably have seen, I bet you some of you have been to these things they call weekenders, where entrepreneurs will get together and they'll build an entire company in a weekend. And the idea is not to know what the company is going to do before you start. You start on Friday night with a whole bunch of beer, you build a company, and by the end of the weekend, you actually have revenue. That's the sport that is played, most weekends somewhere in the Pacific Northwest. And when I wrote the book Early Exits in 2009, I made a kind of a joke in the book, I thought, where I said that maybe one day they'll talk about an early exit as being selling the company before the end of the weekender. Well, that almost happened the same year. Even before I had the book out, some crazy guys in London built a company in one day because building it in 2 days had become kind of passé. They wanted to show that they could do it in one day. There's a really funny video that only takes a few minutes to watch. But what they did is they sold it 10 days later. So they didn't quite get it sold by the end of the weekend. And this was clearly a stunt. But the reason I'm describing it is it does show you how fast things are happening. It really is a completely different world than it was just a decade ago in terms of the time compression. And I sometimes build a list of the companies that I come across that are less than 2 or 3 years old that sell for big money. And this is obviously a pre-selected list. I'm not trying to say this happens all the time, but it is an interesting illustration because it shows you that you don't have to spend a lot of time to build a valuable company. Flickr is a great example of a local company. They sold for $30 million when they were a year and a half old. Delicious, which I'm sure a lot of you have used, sold for $30 million at 2. Club Penguin, one of my favorites, was only 2 years old, $350 million. YouTube sold for $1.6 billion when it was 2 years old. Playfish, $275 at 2, Mint, $170 at 3, AdMob, $750 at 3.5 years old. So these are outliers, no question. But it does show you how fast it's possible to make things happen. A better example is a company that I'm sorry I still can't share the name of, but you could throw a rock and hit the company, 2 throws of a rock from here and you could hit the company. And what this company had was they had an idea for a product. And they did what good entrepreneurs do. They called on some customers. And they showed them a drawing. And they said, hey, if we could build this and we would charge you this much money, would you buy it? And the company was quite interested. And they had a couple of conversations. And by the third conversation, the company was saying, hey, why don't we just buy your company instead? So the CEO phoned me up, all out of breath, so excited he could hardly talk. And he said, help, these guys want to buy my company. And we talked for a while. And to make a long story short, 3 months later, the money was in the bank. That's crazy. That's unheard of in my business now, that you could have it go from an inquiry to actual cash in the bank in 90 days. And this was a classic startup. It was literally 2 engineers. They were subleasing a little bit of space in the corner of a small office just over there. What was a great deal of fun for me was that when we were doing the closing documents, the documents before the closing, and there was things that said like tax returns. I was writing NA. They said financial statements. I wrote NA again because they didn't have any financial statements. This company was less than 1 year from startup. They'd never filed taxes. They had never done any accounting. But they had done one thing right. They had filed a couple of patents. And that's really the reason that this whole story worked, is they had a good idea and they protected it. And filing a patent these days is like, $5,000 or $10,000. Not a big deal. But that's what got these guys a nice exit. It wasn't a huge exit. I mean, it's not like they're never going to work again. But, it was a 7-digit number. It wasn't, it was significant. And it all happened so fast that they might have not even seen it coming if they weren't paying attention. And it happened so fast that I had never seen anything move quite that quickly. An even better example, a story that I love. Anyone heard of a company called Pumpkinhead? Nobody ever has, but you've probably heard of the product, About.me. We've all heard about that. Well, that company was acquired by AOL 4 days after it launched. So the product launched, big PR push. 4 days later, announcement of the exit. That impressed me. I like to see things happen fast. I've seen things happen fast. I don't think that's the right way to measure it, even though it's probably a new record. They should really measure it from when it was started. And it was another 1-year-old company, sold for a much larger amount of money. The thing that was interesting about that was that when I went and did a little bit of online research, the entrepreneurs in that case were guys that had a lot more gray hair than me. And when I dug into their backgrounds a little bit, these guys were pros. They had done this like 5 or 6 times. They'd actually sold companies to AOL before. But to make that happen, it's pretty clear to me that what they did was they looked at the exit like a business process. And I'm pretty sure that they built the exit team and got them started about the same time they built the team to write the code and got them started. So what these guys did was they ran the development on the code through the same months as they did the development on the exit. They launched the product. The guys on the exit team were ready. They closed it 4 days later. That's impressive. And again, it illustrates what's possible today. And it shows you what some real veteran entrepreneurs who get this can do. And these guys are just like a machine. They're just they've got it dialed now, and they're good at it. And again, shows you what's possible and why I call this a golden era.
So I first met Basil in the New Ventures program when we went through that, and heard him say some of the ideas that we're hearing tonight about the importance of planning your exit right off the bat. That sounded like very good advice to me at the time. By the time I got to that seminar, which was the last seminar in the series, I'd gotten this clarity that we weren't going to take outside investment, we were going to bootstrap it. It was also pretty clear to me that the destiny of this company I was starting was to be acquired someday. It wasn't going to be a company that was going to grow and grow and grow for indefinitely. But the idea of actually planning the exit right from the beginning, that was a bit novel, but it really made sense, and I took it to heart. I say here for about 2 weeks. That's a little bit of a joke. There's some truth to that. But the reality is that I remembered that. And when you're running a startup company and building that, every day you're making decisions about all sorts of things. And every one of those decisions was colored a little bit by the fact that I knew that someday, maybe not that far in the future, I was going to be wanting to sell this company. And it just tweaks some things. Sometimes it's bigger decisions than others, but it affects every decision that you make. But I also got pretty busy. The business was starting to be successful. Nothing better than having a successful business that you're running. It does become takes on a bit of a life of its own, though. It becomes a monster that has to be fed. And I forgot about the fact that I was supposed to be not only just preparing for an exit, but actually doing something about it at some point. So the part that I didn't do, the thing I forgot about after 2 weeks, was setting some sort of a trigger event or some threshold of size of the business or a time when I would actually start actively looking to sell the business, not just kind of grooming it for some future thing, but actually starting to do that. Well, a couple of years after starting the business, though, and having kind of not done anything about exiting, ran into Basil at a business event. And again, it's one of these situations where you got to give yourself the opportunity to be lucky. It was very fortunate. I ran into Basil at this event. I happened to be there actually recording stuff, just like we have a fellow here recording things. And there was Basil across the room. We didn't really know each other. I'd just seen him in the seminar. And I thought, I'm as much an introvert as anybody. I don't talk to people. And, I should go just say hi. So I did. And one thing I'll tell you about Basil, he's a very good salesperson. And I mean that in the nicest way possible. And in this case, what I mean is that he sized me up in about 30 milliseconds as a good prospect for his services. And he said a couple of things, really harking back to some of the things we've heard tonight about the importance of thinking about the exit and the timing of that and when you want to do it and so on. And it all kind of came back to me, and it's like, you know what? He's right. This is the time when I should be thinking about the exit and actually doing something about it. So that was my gut feel. Took my head a little bit longer to come along to that. And when you're running a business, you listen to your head, you listen to your heart, you listen to your gut. It's good when they all line up and are telling you the same thing. Sometimes they don't, and then you gotta. And no one of them is guaranteed to be reliable. So I give them all kind of equal weight. But as I was mulling that over, and my various body parts are arguing with themselves about it, I met with Basil a few times. Again, he's terrific at what he does. No pressure. It's just kind of like, here, we're just talking. Let's explore some of the possibilities. He even provided me the names of his competitors in town. He says, you should talk to these people too. Maybe there'll be a fit there for you that's better than me, whatever. He wasn't pushing me away at all, not at all. But just I thought that was very smart. It sort of let me know that he was confident in what he was doing. He realized that if he wasn't the right fit for our needs, then there's no point doing it. Because you get married for a while with your M&A advisor, and you want to be sure that you're going to be happy with that partner to take you right through to the end of the process. You don't want to get partway down that road and then bail out and so on. So anyway, that was great. But I took his advice, thinking maybe giving myself a chance to be lucky again by talking to someone else. I had some good conversations with people, a lot of smart people in town who can help with this sort of thing. But really, it was Basil that I felt I resonated with, and so I came back. So formally engaged his company in March of 2011. So this is, less than 2 years after we put our first product out onto the market.
One of the reasons that the statistics are so horrible about how few companies actually succeed with a successful exit is because most investors, board members, and entrepreneurs haven't thought about the exit timing. And the timing I'm talking about here is from the time you make the decision that Bruce just talked about to sell the company and until the money's in the bank. And in an ideal situation, what I wish companies would do is take into account that it's going to take 6 to 18 months, usually, from when you make the decision until you've got the cash in the bank. And then what you'd do is you'd look forward into time, and you'd, with some magic I'm not quite sure how to do yet, figure out when the peak in the company's value is going to be, and then start the exit 12 to 18 months before that. So what I'm trying to describe here is something that I think of looks like this graph, where if you looked at years from when you started and you looked at some vertical axis measure of the return on the investment or the value of the company, when the company's young, it's going to grow pretty fast. It's just its nature, like young people, to grow fast. And then what I wish we would do is we would figure out the optimum time to start the exit and then sell it right at the peak. Now, that's obviously highly idealized. This is just a concept I'm trying to get across. But what usually happens because of human nature is that instead of doing that, what we do is we wait until sometime after the company's value has peaked. Typically, what entrepreneurs, investors, directors do is they think, you know, it's not quite as easy to get those customers, and wow, it's getting a lot more competitive. Then they start to think about the exit. And they make the decision to start sometime after the company's peaked in value. And then by the time you get down to negotiating with the buyers, it's clear to everyone that the company's best days are behind it. So when this happens, the first thing you notice right away is there's this enormous financial loss. All that money that you could have had if you timed it perfectly is gone. But that's not the worst of it. The thing that breaks my heart more than the financial loss is this enormous part of your life that you just can't get back. Because every day you go to work, you work your heart out, you go home tired, and you go home poorer than when you went to work in the morning because you've missed the perfect time. And the value of your company, no matter how hard you're working, is just declining. And there's often nothing you can do about it. But even that is optimistic. What actually happens about half the time, that red half of the graph is, when you miss the perfect time, you end up with a smoking crater. And this was something that puzzled me a lot because I kept seeing this happen over and over again. You know, I've been watching companies in this town since I was in university, and I kept seeing these companies that I know were saleable, and then the next thing I hear about them is that they're shutting them down. And after seeing this a few dozen times, maybe I'm a slow learner, I don't know, but I started to recognize a few patterns and started to realize that there was logical reasons why, if you missed the ideal time to exit, that there was a terrifyingly large probability that you were not going to just exit for less, but you were going to end up never exiting at all. And some of the reasons that this happens, that I've been able to actually observe, is one of them is overinvestment by VCs. One of the reasons that VCs are a lot less prevalent today is this is one of the things that they do inadvertently, and they create this kind of problem. Not necessarily in the companies they invest in, the ones they didn't invest in. Competition is happening, like everything that the internet is accelerating, it's happening much faster than ever before. Whatever lead you have, you should hear that there's people behind you breathing hard, catching up, and you should be able to hear their footsteps because they're there. Intellectual property infringement is another really scary thing that is happening more and more all the time. If you've got a good idea, if you've got a patent, if you have a patent, please sell the company as fast as you can. Negative momentum is a group psychology effect that can happen once the company hits that peak value. I'm not sure if any of you have seen it, but when I talk to groups of investors with gray hair, you can see the guys in the room going, I know exactly what that is. It's terrifying if you ever actually do see it. And waves of consolidation are another one of these new things that is driven by the internet. It didn't used to happen very often before, but it happens all the time now. I can't possibly do justice to all these things. This would be like a 2-day seminar on what all these are. But I have been able to record some of my other talks, and there's a lot of this kind of content on my blog if you want to find out what it is. But for now, I just hope you remember that there's at least these 5 things that will probably kill you if you don't find that optimum time to exit. And that's why the probability is only 25% after you build a good, valuable company, that you still might not end up getting the cash you deserved. Missing that wave is one of the most heartbreaking parts of this. And I'm going to go through this really I'm not going to go through this at all because I don't have time. But this wave is one of the things that I think that if you've got a company that's valuable and you don't really understand this, I think maybe if, in an ideal world, that would be the CEO's most important job after you got there, is not to miss that wave. Because that is really, a bad reason not to actually have a successful exit. And instead of that terrifying story, we're going to hear more about Singular's very successful and well-timed exit.
Timing. So you've heard my first philosophy of life is that you should always give yourself the chance to be lucky. My second philosophy of life is that timing is everything. It's often so much more important than how much time you spend on something. It's when you do it. And picking your moment or trying to pick the right moment, timing just counts so much. So in the case of Singular Software, my company, as I mentioned before, we engaged Basil's services in March of 2011. And within the space of a couple of months, we had the package, the M&A package put together for potential acquirers. So there's a financial model for the business. There was the information memorandum. Basil mentioned how long it can take from the start of the process through to the end. We fell sort of smack in the middle of that range. It took about a year. And we closed the transaction in July of 2012. So about 3 years to the day of when we sold our first product. And about 16 months after signing the agreement with Basil. How did we get there? Well, Basil and with some assistance contacted a whole bunch of companies. Obviously, I knew the market fairly well. I suggested here's a long list of potential buyers for our company. Basil came up with several more that were potential prospects for us, and we actually did get some responses to that, and more than one written offer. None of them were terrifically exciting to me, and although I had early on decided what kind of an exit this company was going to have, namely an acquisition, I was also prepared for the fact that maybe it wouldn't happen. Maybe the right buyer wouldn't come along, and I would just keep growing the company for indefinitely. But somebody did come along, Red Giant, which is a company that is quite well known in the space of video plugins and so on, very similar to the market that my company was in. They didn't have competing products, they had very complementary products. And much to my embarrassment, they weren't on my long list. They absolutely should have been. But they approached us at one of the NAB shows a couple of years after the one where we launched. And they were interested. And this is a good example of giving yourself a chance to be lucky. It's not necessarily lucky to have someone out of the blue offer to buy your company if you're not ready for that. It might be the wrong time for you. You may not have done all the things that you need to do to be ready for that. And I'm sure Basil can give you all sorts of stories about how that can, the blessing can not be that great. In our case, though, we were totally prepared. They were pretty surprised when I said, yeah, in fact, sure, we're interested in talking to you about strategic opportunities together. In fact, I've got my M&A advisor here with me at the show. Why don't we all just get together? That's being prepared to be lucky. So I was lukewarm about the other offers that were on the table, but they were just about interesting enough that maybe I would have made it work, could have made it work. But I liked these guys right away, the Red Giant folks. I got to meet the founders. There's 2 founders there, and they built a very successful business, really had a nice philosophy about how they ran their company, a pretty virtual company as well, so that aspect I thought would fit in. And this time my gut said it would be a good fit, and in fact it's turned out that way. It's been a very good fit, and my head went along with that one pretty quickly as well. I was really happy to have Basil on board with me at this point because I'd been involved in many acquisitions before, and companies where I was being acquired, not companies that I had started. I wasn't a founder, I wasn't a principal in the company, but I was senior enough that I was seeing it all happen. And I knew how consuming a process that can be emotionally and just time and everything. And I wanted to kind of stay a little bit away from it because it might not work, right? Lots of times you can go down the road with a potential acquirer and it just doesn't work out. And then you look back and think, gee, we just spent months spending all my time on that. And my business is like, meanwhile, gone sideways. I really didn't want that. I wanted to keep building the business and just in case things didn't work out. Plus, I just didn't like the idea of negotiating all those sort of details and things. I was just so happy to have someone with Basil's experience there to do that. And that proved to be not just a convenience and a nice to have, but there were some really critical points in just the nature of the transaction between the two companies where Basil really got us over the hump of something that could have ended up being a complete roadblock. And he just had like a creative idea that got us past that. So the value, I think, of the M&A advisor, in this case and in my other cases, in my experience, is not so much that they're going to bring the buyer to the table, maybe, but it's when the buyer's at the table and then you enter this negotiation phase. That's when the value really kicks in for me. What value? Ensured the deal actually closed. Which is not a given at all, no matter how interested the buyer is and how interested the seller is. There can be all sorts of roadblocks that get in the way. But also ensuring that the terms of the deal met my goals. I had some specific ideas about why I was wanting to sell, which had to do with not really wanting to build a really big business and manage a big business. I was having a lot of fun in this smaller kind of environment, which is the smallest company I'd worked at for many years at this point. That was good. Taking some money off the table was obviously terrific. But also giving the product, which I really still liked and was quite young, giving it the chance to succeed in a bigger environment with a little more oomph behind it that a larger company with a bigger market presence could bring to it. So all those factors were clear to me, and Basil and I talked about them, and that they definitely played a role in how the deal was shaped. And at the end of it all, I remember it was done. We got together for lunch, and I said, Basil, that was absolutely amazing. I think that was the word I used. But it was good. I was quite happy. So I mentioned I'd been involved in a lot of previous transactions. That experience and seeing how difficult it can be in the final stages of an acquisition informed a lot of the decisions I made about how I structured my company. Not having outside investors, I was really glad I didn't at that point because they can really get in the way. They might want to take a deal that you don't want to take, or vice versa. You got all these people to babysit who are investors and they're stakeholders in the process in a big way. All the shares in my business were owned by my family, so we just had ourselves to argue, and that wasn't too tough. Red Giant is an American company. We're a Canadian company, so there's cross-border stuff that happens there. They hadn't acquired a Canadian company before. Again, Basil's experience here really helped. There's just lots of things that come up. None of them fatal, but if you get it wrong, it just makes it a lot messier. And who knows, there could be enough traps there that could scuttle the deal if you do get it wrong. The taxes are really a whole lot of fun to think about. In any case, and when you're going cross-border, it's extra fun. So Basil introduced Don Fernie of PwC, who was an expert in these kind of things, and so he kind of jumped in, took a look at what it was, prepared some discussion papers, and really helped me and the buyer get over some issues and help structure some things creatively and with a lot of insight that made the deal work.
So to summarize, before we start the questions, I hope that you keep in mind that most acquisitions are under $15 million, and that modern companies don't need much capital, and that if you can possibly do it, bootstrapping is probably the best option and will probably give you the best result. If you need capital, today angels can finance up to $5 to $10 million. there's so many angels out there. It's really, again, a different environment. And the optimum exit strategy for almost every company is to think about targeting an exit for under $30 million. And to maximize your success and to get into that 25% that have the successful exits, I think you should start planning right at the beginning with the end in mind. So that's the end of the presentation. Let's have some questions. Yeah. Oops, wait, sorry.
Microphone.
For our friends at home in the webcast and for the future viewers.
So the reality that you're talking about is most acquisitions are under 15 million. Are investors aligned to that reality? Because it almost feels that investors are lagging that reality as well in terms of when they say, you know what, what's your valuation going to be, or what do you think your target is? If you say 15 million or 12 million, it almost seems that they're going to be like, whoa, that's way too small.
That is an excellent question. I spend a lot of my time when I'm putting back talking to groups of investors instead of entrepreneurs. And they're as shocked as anybody when you tell them that the median exit valuation is like $12 to $15 million. They're starting to get it. You know, if you went to Seattle, for example, there's a large number of very sophisticated angels there. They understand that. And what they understand then is that does limit how much capital you can put into a company. Because you can't put more than a couple $1 million into a company that's going to exit for most likely 15. So you've really got to match the investors to the opportunity. And it's one of the reasons there are so few venture capital funds left in operation, is because they were all shooting for these $200-300 million exits, which in all of British Columbia only happen every other year, and most of those don't have venture capital. Like Club Penguin had no financing. Club Penguin was bootstrapped. $350 million exit in 2 years. Again, showing what's possible. Great question. Who's got the mic?
So how do you determine the valuation? If you're going to exit for, say, 15 million, how does that relate to things like sales and revenue?
A good question again. There's no simple formula. There's a range of methods that are used to value companies. And there are also people out there that will want to charge you to value your company. I say, and often get myself in trouble at meetings like this when I say that I don't think you should pay anything more than a cup of coffee or maybe a lunch to find out what your company's worth. There's lots of people in my business, my industry, who are happy to listen to a company, tell their story, get a few numbers, and give you a pretty good estimate of what your company's worth. There are also a lot of places online we can go now, since everything is indexed and available online. You can find some pretty comprehensive benchmarks of what private companies and public companies are worth. And it's different depending on the type of company. Like software companies, there's about a dozen different categories of what the multiples are, because they vary over a huge range just in software companies, for example. So no easy single answer, I'm afraid.
Hi. You mentioned briefly that if you have any patents, you should sell your company as quickly as possible. Could you elaborate on that, please?
Yeah, this... You want to start with that one?
I'll let you start
All
that
right.
one up. That was your line.
This is another way. No, and this is something I've been talking a lot about recently, because patents have become a much better tool for entrepreneurs. They're fairly inexpensive to file now, and they're fairly quick, especially if you want to use the accelerated process in the States. And you can make a lot of money from patents. You know, we sold a company, I invested in a company 3 times called Brightside, which was a UBC spin-out that made some fabulous technology to vary the intensity of LED backlights for liquid crystal displays. They kept trying to build a factory, completely failed at that, but they had this really great patent portfolio. We sold that to Dolby for $28 million. No revenue at all. Again, interesting valuation question. But the problem with patents is that today, especially in the technology sector, big companies have the attitude that they can't wait to find out if they can license your technology. They have the attitude that if you've shown them something interesting, even under an NDA, the smartest thing for them to do is to put that into production as fast as possible. And they don't mean to be stealing it. They just don't have the time to wait. And then what they do is they have the attitude of letting the lawyers figure it out later. And if you want to see this in action, just read about the patents battles going on between Samsung and Apple. There's an example of this playing out that you can follow. It's like a drama on television. It's so interesting. But that's a battle of equals. The problem with a small company is that if Samsung decides to infringe on your patent, you can't even enter the arena in the contest.
Okay, so not really an exit question, but to follow up from that, if you're entering a potentially competitive space, would you recommend just keeping your technology as a trade secret rather than patenting?
That's a good question. And I think that in a lot of cases that is the better route to go. And I'll echo what Basil was saying about it's difficult for a small company holding a patent, no matter how great it is, to assert that patent. It's a very expensive process. And you might be up against some people with big law departments and so on. So plus it can be, depending on the exact nature of the patent, it can be hard to establish that they are infringing, in fact, because it's all kind of, the end result might be the same, but are they really, violating what you've given them? The other thing is, when you create a patent, the whole idea is you granted a patent because you are disclosing to the world how you're doing your magic thing. And that makes it easier for other people to either work around it or just steal it or, whatever. So there's a lot of reasons to just protect it as a trade secret. We patented our algorithm, I guess because the nature of it's one of these ideas that when you hear about it and you have the general idea of the approach that's involved, and that would have to be public, people have to know how to use the software, then everyone thinks that they can do it themselves. How hard can it be? That was the question I asked myself. It turns out it's pretty hard, but everyone thinks, how hard can it be? And so it seemed valuable to have this patent in our back pocket as a bit of a defensive mechanism. Part of the rationale for us getting the patent is to make sure we weren't infringing somebody else's patent. So you go through that process as part of the discovery and filing the patent. But protecting it as a trade secret is not a bad way to go. Every other company I've worked at really protected everything as a trade secret.
Next question.
Can you tell us more about sort of how to assess when that peak point is in your valuation, and what kind of things to look out for? So we actually have a life science company. Typically, they have much longer timelines and all of this. So if you've had any experience in that domain and how people think about M&A and when to time it.
It's a combination of you want to be on that growth curve for sure, and you want to use every scrap of understanding you have of your industry to imagine where it's going to go in the next couple of years. In our case, we had that good fortune to bring our product out at the right time when the industry was in this transition phase. But it was clear to me that when people heard about our technology, they would have this idea that they would think they would know how to do it too, and there would be competition. I expected the competition wouldn't be very strong technically, which is true. It's happened, it turned out that way. But it's enough to be disruptive to the business, right? And so part of the strategy of getting our product into a bigger company was that they would be better able to withstand those competitive forces than a really small company. That's about the best answer I can give. And again, you've got to listen to your gut and your heart and your head and imagine the future as best you can and try to imagine where that's going to start, that growth is going to start evening out or flattening out because of competitive forces, market changes, all those things. Definitely know there's no formula for it.
15 years or so ago when I was running a venture capital fund, we used to have a separate fund for life science and technology investments because we believed, and I think it was true then, that investing in technology and investing in life science and exiting technology and life science was very different. So it didn't really make sense to combine them. They were that different. The fascinating thing for me, like so many parts of what's happening in the economy, is that the life science company financings and exits today are not very different from tech. They've almost converged. I think life science was kind of a younger industry 15 years ago, but the economic fundamentals apply in both cases. So what we've seen just in the last 5 years or so is a lot of the big life science companies, the big pharmas, have just wholesale shut down their R&D departments. They said, they finally realized, like the tech guys did, maybe 5 years later, we suck at R&D. Now they're going out and they're saying to the entrepreneurs, we want to buy your companies. We don't care if you're fast. You know, we don't want you to try and get them past phase 2 clinical trials anymore. That's way too risky. We're good at that. Now what they're doing is they're doing the same thing. They're buying them much earlier for much smaller values. So today, I'm seeing lots of very successful life science companies, even drug discovery companies, that are bootstrapped. They're taken to a stage where you can show the very beginning, sort of the minimum viable product, well, the minimum viable efficacy, and they're exiting for the same kinds of values. It's a whole different thought process, both in the buyers and in the sellers. But good news for the entrepreneurs. Next question. Anything at all is fair game. This is the last in the series, so you can ask about anything that you've heard before, anything you think I might disagree with in an interesting and humorous way.
What about selling all the company and keeping a small percentage or a percentage for yourself?
Well, we did something that's kind of a variation on that, which was we sold the assets of the company, but the company that I started actually continues to exist. That's convenient because that gives me the opportunity to do something else interesting with that company, and I've already got that corporate structure there. It also means that as I continue to play around with ideas and I want to buy toys to have fun and play with those ideas, I can do that within that company. So there's sort of business tax advantages and things in doing it that way. Certainly that. On the other hand, there's tax advantages in selling the company as opposed to selling the assets of the company. So that's a discussion you want to have with your accountant. If it comes to that. But if you see a way to split up what you've got and the buyer's really interested in this, but you're still kind of interested in this and think it has potential, it's absolutely an option to split it out.
And there's another interesting new phenomenon that's happening today in something they call private equity funds. I'm not sure how familiar that term is, but a lot of the people that used to be venture capital fund managers are now private equity fund managers. The only difference really is that the private equity guys want to buy almost all of the company. They usually want you to keep part of it, and they want you to continue to run it. And one of the reasons it's interesting is a lot of times when you read in the press about these big venture capital financings in town, locally, a lot of times what's really happened is exactly what you were suggesting. The entrepreneurs and the angels sold almost all their stock. And in some cases, the entrepreneurs sold 100% of it, even though it looked like a big venture capital financing. The only way you can tell is if you notice a number of months later, they're not showing up at work anymore. That's how you can tell it was one of those kind of deals. But because there's so much money out there right now, the venture capitalists are finding that they have to behave like the private equity funds just to be competitive. Because the entrepreneurs these days much more likely to say, you know what, we want to sell all or almost all. That's kind of where the market is. And so it's happening quite often. Next question.
What do you think of rights of first refusal as kind of a tool to get things going for entrepreneurs? So it's like if you have a technology going and selling that, or
it's hard to describe how bad of an idea that is. It's one of those traps that it's so easy to fall into when you're in need of capital. And usually it's a strategic investor. The dream investor, like a big brand name company in your space says, sure, we'll come in, we'll buy 10%, but we want to have a right of first refusal to buy the company, right of first refusal to, whatever. And what that will do for sure when you come to have that opportunity to sell is it will completely change the whole dynamic. Because if, for example, we were selling a company that had a right of first refusal, we would have to tell everybody right at the outset, oh, there's a ROFR on this deal. And what they'll think right away is, okay, there's somebody involved who knows way more than we know. They're probably going to buy the company anyway. These guys in the suit are probably just trying to get us to make a bid to get the price up. We're going to put 6 months into figuring this out. We're going to get the rug pulled out from underneath us. If that doesn't happen, then we probably paid too much because the guys who knew more than we didn't want to buy it at that price, so we probably screwed up anyway. So it almost poisons the whole process. So it's, if it's that or death, do it. But if there's any other option, I would advise you to look hard at the other option.
Every decision like that you have in front of you, think about what's this going to mean at the exit time. And if it's going to complicate it, go the other way.
Yeah. Keep it simple for sure.
Keep it simple.
Who's got the mic?
In all of your experience with startups being acquired, what is usually the plan for the founding team and the original members, etc.?
Yeah, in my experience, they want most of my, I'm in the software world. They want the technical team for sure, and they'll often shed almost everything else. And it depends a lot on how technically involved the founders are, perhaps. I know a friend of mine who's also been involved in a lot of acquisitions and things, and said his philosophy when he's acquiring companies, the first thing he does is fire all the founders. Because they just get in the way, and often it just doesn't work out, and they're entrepreneurs, and they're not suited to a corporate thing, and the bureaucracy drives them nuts after about 3 days. But it depends on circumstances. If you've got founders who are really businessy types, there probably isn't that much of a role for them after an acquisition because all that structure is already there in the acquiring company. If they're core to the technical team, they were the visionary genius that invented the thing, they probably want to have them around at least for a while. And it's certainly very common to see that kind of a founder even tied contractually to stay with the acquiring company for some period of time, a couple of years.
Typical contracts are 1 to 2 years for the founders.
With your trend on early exits, 20 people, $20 million, in order to get an M&A advisor to do the process, the exit process, along maybe simultaneously as you build the company, as you said about me, how likely is that for an M&A advisor? Are they trending that way as well?
Yes, they are. It's not fast enough, in my opinion, but there are some really good people in Vancouver who run firms that will work at very early stages with companies that they like. And almost everybody in the industry is happy to meet companies at any stage because that's when you can get involved and maybe help a little bit with the exit strategy, help guide them a little bit. And in the industry that we're talking about, things happen in years. So it's a long-term view that you should have, and correspondingly, most of the M&A advisors do as well. So it's not as hard as you might think. They're at VEF events. They're at, they'll probably be at the awards ceremony when you guys graduate here. So it's not very difficult to get people involved early. No other questions? Last chance. Okay, well, thank you very much, ladies and gentlemen. You've been a great audience. I hope this has been helpful, and congratulations again on finishing the New Ventures seminar series.
I can't believe nobody asked you to tell the story about your was it the bad exit or something like that? Anyway,
you can watch the video. You don't want to end on a sad note. It did succeed, but it succeeded only because of luck. I was lucky, as Bruce said earlier, rather than smart. And I don't wish that on any of you. Be smart instead.